makers and market movers. This is The Pulse.
Good morning, everybody. Welcome to The Pulse. I'm Anna Edwards, in for Francine Lacqua here in London. Now, the French President Emmanuel Macron is renewing calls for China to help end the war in Ukraine during his three-day state visit. Macron is also hoping to boost Chinese investment in France and rebalance economic ties. He's urged Xi Jinping to back Europe's stance on Ukraine, saying both leaders need to work on a sustainable and lasting peace.
We both realize how serious the situation and the need to have a solid and sustainable peace. You know how much France has committed to that. I wish we can reinforce our cooperation on this. As members of the Security Council of the United Nations, we have a responsibility and we need to do everything we can to find compromises.
President Xi Jinping described their talks as frank and fruitful. He says China is ready to work with France, suggesting their strategic partnership moves forward steadily in the next 60 years.
China is ready to work with France, always bearing in mind the fundamental interests of our peoples and the long-term interests of the international community, to overcome various disturbances, adhere to dialogue on an equal footing and open cooperation, ensure that the China-France comprehensive strategic partnership moves forward more steadily and effectively in the next 60 years.
Bloomberg's Caroline Conan has been following the details, usually based in Paris, of course, over here in London today. Caroline, good morning to you.
Good morning, Anna.
So what's been discussed? What's been on the agenda?
In fact, in that same press conference earlier, President Emmanuel Macron talked about the disaggregation of the world order. So that's quite a strong word to describe what's going on. And Macron is seeking the support from President Xi in trying to get to the finishing line of these peace negotiations to end the war in Ukraine. Because he believes, as you heard, that China is also on the Security Council seat at the UN and has a role to play. And obviously, President Xi has maintained some relationship with Vladimir Putin since the beginning of the war by buying some Russian oil, even though they have cut some of these purchases recently with the US sanctions on Rosneft and Lukoil, and also by selling components to Russia. So clearly, this is what Macron is trying to do by being the messenger of the EU. Last time he went to China back in 2023, the EU Commission President von der Leyen came with him. This time he is alone, being the voice of the EU. And in exchange, of course, Xi is trying to get some support from Macron about the issue of Taiwan. We actually heard from the Chinese foreign minister who had a meeting with his French counterpart, Jean-Noël Barrot, and he said that France should help China to tell Japan that they should not stir up troubles in the region, or we risk going back to World War II.
OK, so some of the geopolitics clearly being discussed and Europe trying to enlist China's support when it comes to Ukraine. There have been areas of tension around business, and I'm thinking of cognac, but there are others around retail as well. What is going to be said or done around these areas of tension between the two?
I thought what our guest from Pictet Capital told us earlier was quite interesting. He said these state visits are less useless than people think. So, in fact, the fact that they are talking to each other, there are these huge delegations of CEO, including the Danone CEO, Rémy Cointreau for Cognac, Airbus, who is expecting to sign some order with a Chinese leasing company. This is obviously very important, and we know that China was tariffs against cognac makers were in retaliation to the French president supporting the EU tariffs on Chinese EVs. This has kind of been solved because now Paris has managed to negotiate some kind of price scheme excluding 90% of cognac exports to China, but there remains a lot of issues about EU exports of pork and dairy products. Macron said this morning there has been progress, but a lot needs to be made still on these two issues. OK, Caroline, thank you very much. Caroline Conan with the briefing. Let us get up to date with some of the other news flow we're focused on this morning. The Japanese Prime Minister has reiterated the country's long-held position that it understands and respects China's view on Taiwan. Sanae Takaichi comments in Parliament on Wednesday have been seen by some Chinese social media users as an attempt to walk back remarks last month in which she suggested that a Chinese attack on Taiwan could mean a, quote, survival-threatening situation for Japan.
Back to Europe, and the German Chancellor Friedrich Merz and his ruling alliance with the Social Democrats face another challenge after a group of younger CDU lawmakers rebelled against a pension bill due to go to a final vote in the Bundestag on Friday. The Social Democrats' co-leader hinted this week that if the pension bill doesn't make it through, it could spell the end of the coalition. Back to markets, and expectations of a Fed rate cut are higher after US companies shed payrolls in November, at least in the private sector, according to the ADP report. And that shedding was by the most since early 2023, adding to concerns about a more pronounced weakening of the US labour market. Let's get some context and a view into 2026 then around this with Maria Vassalou, who's head of the Pictet Research Institute and joins us now. Maria, nice to have you with us. So I suppose that's the backdrop to our conversation this morning. Rising expectations, we get a Fed rate cut next week. Looking ahead into 2026, a lot of people asking, how many rate cuts will we get? Will we get the right number of rate cuts for the US economy based on who is at the Fed? So what's your thinking about 2026, Maria, when you look at the year ahead? The last conversation I had about this in the last hour of programming was all about resilience. Are you thinking that the global economy and stocks in particular look resilient into 2026?
The U.S. stocks and the global economy is very much affected by geopolitical developments at the moment that are actually driving the macro picture and effectively also the stock market. So we are at a unique time in our history where geopolitical developments, all these discussions you just had about the war in Ukraine, the conflicts in Asia, the posturing between China and Japan, the policies of the U.S. are creating a lot of uncertainty in the world. And obviously we have seen trade relationships being upset and renegotiations being underway in terms of trade agreements. And all these things create a lot of uncertainty going forward that weighs on stock markets. OK, so it's that uncertainty that's on your mind heading into 2026. Something else that is very much increasingly on the agenda is demographics. I mean, what's been going on in Europe in terms of demographics with low fertility rates and now pushback against immigration? This has been clear for some time. But I suppose the pace of change is accelerating, and the possibility that AI counters that demographic threat is also out there now and increasingly in the market conversation. How are you thinking about that ageing demographic now, Maria? It's very interesting that when we look at these two topics, they're often discussed very separately. So people are very concerned about the fall in birth rates and worry about the availability of labor. And on the other hand, they worry a lot about how technology and AI can eliminate jobs. But in fact, technology never evolves in a vacuum. It evolves in response to societal needs. And labor has always been in short supply. It has always been scarce. And so I believe that this new revolution of automation and AI comes at the right time. Also, in terms of immigration is a zero-sum game. It doesn't affect the total number of working population in the world. It just moves population from one part of the world to the other. So it can be a short-term solution, but it doesn't solve the long-term needs of an economy. So are you an AI optimist in terms of what it does to productivity and its ability to deliver for the global economy against some of these big challenges that we now face? AI and automation is the only chance of the developed economies to support their growth and improve their efficiency and deal with the shortage of labor in their economies. Immigration by itself cannot really solve this issue. And the politics, of course, of that has been complicated for some time. So when you look, so if that's the backdrop and AI and productivity are big things to discuss in 2026,
what do winners and losers look like? I mean, clearly hyperscalers have been setting the pace, investing a huge amount of money in rolling out data centers. But now the AI build-out spreads into other sectors, energy and far beyond. So, Maria, what do the sector winners look like to you?
There is a lot of focus on tech itself, and of course that's the main driver behind this technological evolution. But I think focusing only on the tech sector is not necessarily the right thing. What we need to focus is on the different sectors of the economy that can benefit from automation and AI, and in a way that improves productivity. So there are two things that are happening. There are changes in consumption demands due to the changing demographics, and at the same time there's the ability to produce more efficiency in the production space through technology. So even sectors like food, agriculture, real estate, housing, and of course healthcare can benefit a lot from this revolution.
Okay, so these are the ones that should benefit. Are there sectors that are going to be left behind by this?
Well, we see that as the young generation is less interested in luxury goods, and as they progress to middle age, their consumption of such items goes down. At the same time, the spending on transportation in terms of vehicles goes down. The spending on entertainment goes down. So there are some sectors that could see a decreased demand due to the evolution of demographics. But I would focus on three factors: whether a sector is conducive to automation, whether it caters to the evolving demographics, and whether this sector is really considered in an economy that has the infrastructure to support the productivity gains of that technology.
Okay, thank you so much. Thank you for joining us. Really good to get your perspective. Maria Vassalou, head of the Pictet Research Institute, joining us to talk about AI and much beyond. Coming up, we'll turn to the mining sector. Rio Tinto announces plans to slim down and focus on copper and iron ore. More on the new chief executive's vision next. This is Bloomberg. Welcome back. This is The Pulse, live from London. Now, Novo Nordisk has left the door open to continue work on a pill version of Ozempic to treat Alzheimer's, even after 2 failed trials. Let's get more with Naomi Kresge, who joins us now, Bloomberg's senior healthcare reporter. Good morning to you, Naomi. So clearly Novo is still hopeful that there's something to do here. The share price is down a little today, but maybe that's not linked to this. We've seen some failure in some trials, but still reasons to hope. What's the Novo story?
So they presented late last night in San Diego the initial top-line results of these 2 trials that failed to show any impact on cognition from the pill version of Ozempic. What they did show was a small impact on biomarkers, so markers of what's happening in the body. This wasn't enough to change anything about the progression of the disease, but they did say that before they make a decision about what to do next, they want to spend some time analyzing this data, and they'll have another presentation of data in March.
Okay, so this is one area that we could see them trying to explore use of these drugs. Meanwhile, Reuters is also reporting that Novo is planning to launch Ozempic in India. Now, this would seem like a big market, potentially a lot of opportunity there. How big is the opportunity for the business?
India is a big market. I mean, it's a very interesting dynamic there because Ozempic is actually going to be generic in India from next year, and there are a lot of generic drug makers that are also lining up to sell semaglutide, the Ozempic molecule, in India. The number of people in India who will be treated for diabetes is definitely increasing. Nomura estimates that this population will go up from 51 million people this year to 61 million people by 2031. So there is a growing market, and a large portion of that will probably be taken up by generic Ozempic. And so this introduction at this point is an interesting move by Novo to sort of get in the door before these generics come in as well.
And if we think of the use of Wegovy and Ozempic, I mean, Novo is also facing potential compensation claims from some patients who say they've developed eye problems after taking these drugs. What do we know about this?
That's right. In Denmark, there a number of patients, a growing number of patients, have filed claims saying that they've had eye problems as a result of taking these medicines. Now, normally in Denmark, the government would pay compensation in these cases. But there are reports out of Denmark this morning saying that there will be a review of whether the government can ask Novo to cover those costs instead. And so this will be a developing story.
Naomi, thank you very much. Thanks for the update. Naomi Kresge, Bloomberg senior healthcare reporter with the latest on Novo Nordisk. Let's pivot to the mining sector. Rio Tinto shares paring gains this morning after the new chief executive outlined plans to raise as much as $10 billion to be reinvested in the business. Simon Trott also plans to pull back from lithium and focus on areas like iron ore and copper. Joining us now is Bloomberg's metals and mining reporter Martin Ritchie. So, Martin, what stood out to you then from these announcements? The share price just falling back a little this morning, but what's been the big takeaway?
Yeah, as you said, it's the first sort of big opportunity for the relatively new CEO, Simon Trott, to sort of lay out his strategy for the years ahead. And what it was all about, or the message he wanted to deliver, was about simplicity, selling some assets, perhaps selling stakes in others, offloading some infrastructure businesses that Rio has, cutting costs, talking about 4% cost reductions on a unit basis per annum up to 2030. And as you said, sort of reining in the ambitions a bit on lithium, which they're one of the only major miners to go into lithium, saying that we won't commit any more funds than what we've talked about already. So all in all, this is about sort of delivering a message of, we're being more focused on our major markets. Copper is one of them. A lot of miners want to get more copper out of the ground. And iron ore as well is still a big earner for Rio.
Yeah, let me ask you about copper. Copper at fresh records, not far from fresh record prices right now, Martin. What's driving the gains? Is this still all about the supply story that we've been covering from various angles this year?
It is to some extent, yeah, but there's a kind of twist involved here. Yes, there are worries about sort of ongoing supply with copper, and demand is growing reasonably strongly. But right at the moment, what's happening is that traders are expecting US import tariffs next year. They're trying to get as much metal to America ahead of that. Some talk of maybe 500,000 tons going to the US, even in the first quarter next year. And what that's doing is sort of raising the prospect of like immediate shortages in the rest of the world. The rest of the world is what kind of sets the LME price, the London Metal Exchange price. And that's why we've seen those kind of big run-ups in recent weeks, way above 11,500 now. And because it's a kind of slightly temporary phenomenon, this tariff trade, there is talk of prices perhaps coming back down later next year. We've seen Goldman say that already this morning in a note.
Martin, are we getting closer to an answer on what the tariff future is going to look like for copper? Do we have actual facts on that? I suppose this could remain volatile.
It could remain volatile. It's uncertain what the timing is. People are just guessing what's going to happen really at this point. But what happened this year was there was going to be a decision on copper tariffs for the most traded type of copper, the one that you get on the exchanges. Trump kicked that into next year for 2027. So at some point next year, you have to decide that. I would note that Goldman said their base case is that there will be a decision on that in the middle of the year, in June, which could be implemented pretty much straight away, so earlier than expected. So still a lot of surprises possible in store for copper next year.
Martin, thank you very much. Martin Ritchie, Bloomberg's metals and mining reporter. We thank you for the briefing. Let's get some corporate news flow now. And Meta is facing a full-scale antitrust investigation by the European Union over whether its AI features in WhatsApp are harming competition. Sources say the European Commission is preparing to open the investigation, potentially over the coming days. Meta has not yet responded to a request for comment. Nvidia is on the verge of securing a major lobbying win after US lawmakers kept a measure out of must-pass defense legislation. The so-called GAIN AI Act would require chip makers, including Nvidia and AMD, to give American customers first dibs on their powerful AI chips before selling in China and other arms-embargoed countries. Sources say this measure is not included in the defense bill, though the situation could still change unexpectedly. The Nvidia CEO has said he's not sure China would accept the company's H200 AI chips, even if US restrictions are relaxed. Jensen Huang also urged the United States not to give up on the Chinese market.
Going toe-to-toe against anyone, the American technology industry has nothing to fear. We are mighty, we're fast, we're inventive, we'll take anybody on. In the case of China, we shouldn't concede the entire market to them. They're formidable, but conceding that entire market, we ought to go compete for it.
Bloomberg has learned that Meta has poached Apple's most prominent design executive as the owner of Instagram and WhatsApp accelerates a push towards AI-enabled consumer devices. Alan Dye had run Apple's user interface design team since 2015. Sources say he will be replaced by longtime designer Stephen LeMay. Now, the Trump administration will increase vetting of applicants for H-1B visas with a specific instruction to reject anyone who was involved in a, quote, censorship of free speech. The instructions were outlined in a State Department cable seen by Bloomberg and were sent to U.S. missions abroad on Tuesday. H-1B visas are designed to attract high-skilled workers and are widely used within the tech industry. Bloomberg understands Paramount Skydance has more than doubled the proposed breakup fee in its offer to acquire Warner Brothers Discovery to $5 billion. The sum would be paid to Warner Brothers if a deal is agreed to, but not consummated. Sources say it's a sign Paramount has confidence its proposed merger would pass muster with regulators. Warner Brothers, the parent of HBO and CNN, is weighing offers from Paramount, Netflix and Comcast and could choose a winner in the coming weeks. Bloomberg understands the Pentagon watchdog has concluded private messaging by U.S. Defense Secretary Pete Hegseth risks endangering American troops. A classified report by the acting Pentagon Inspector General says Hegseth violated government policies when he used the Signal messaging app on his personal phone to send secret information about the U.S. mission against Houthi rebels in Yemen. A Pentagon spokesman says the report proved no classified information was shared. Coming up on the programme, I'll be speaking with Greg Fleming, President and CEO of Rockefeller Capital Management. We'll get into a conversation about high net worth individuals, about where they're putting their money, about the US economy, how it approaches 2026, all of that in the mix as we get into that conversation. How is AI also changing the management of money for the wealthy? All part of the conversation still to come. That's next. This is Bloomberg. Welcome back. This is The Pulse. I'm Anna Edwards, live in London. These are your top stories. The French president calls on China to use its leverage with Russia to help end the war in Ukraine and warns against disrupting the world order. The US Special Envoy Steve Witkoff to meet Ukrainian officials today after his talks in Moscow. President Trump says the path forward remains unclear. Plus, Bloomberg learns that Morgan Stanley is looking to offload some of its data center exposure, while Microsoft pushes back against suggestions that AI sales have been sluggish. Welcome back to the programme, 9:30 here in London. We've spoken a lot recently about how the US is perhaps a K-shaped economy where the highest earners are getting a boost from their investments, which in turn allows them to continue spending. But what exactly is driving the boost in investment returns? Maybe AI features in this conversation. Let's get to Greg Fleming, President and Chief Executive of Rockefeller Capital Management, which manages the investment portfolios of some high net worth clients. Greg, very nice to speak to you. Thank you so much
Good to be here.
for joining us. So let's look ahead to 2026 then. And I've had a lot of conversations about, on the one hand, resilience, on the other hand, geopolitical turmoil. And I wonder how that makes the US economy look to you in 2026.
Well, Anna, I do think overall the resilience has continued to be there and the economy has hung in. But I do think in the last 6 or 12 months, there have been major pockets of the economy that have been more sluggish, rate-sensitive areas, manufacturing with the whole onshoring and everything going on tariffs. And you see that in the employment data. And yesterday there was an ADP report that was actually just flat out not good. So we'll see where it goes from here. I think there's a Department of Labor report in a week or two. But employment has been sluggish, and there are major parts of the economy that have been sluggish. However, overall, it's held in. And obviously, part of the reason it's held in is AI and all the investment in AI. And we expect that to continue.
Yeah.
We also expect in 2026 there to be a significant amount of stimulus. You have midterm elections late in 2026. So, from a fiscal standpoint, the government's going to do what it can to keep the economy going.
Yes.
We think the Fed is focused, and this will impact their decision next week, on the employment data and the weakness in the labor markets. So I expect them to drop rates next week, and I expect them to be focused on that side of the equation, maybe slightly more than the inflation side of the equation in 2026.
OK, and is that a reason to be a little bit nervous? If we have a Fed that is very much focused on the downside, the labour market story, and not so focused on inflation, especially as you have so much capital expenditure around the AI theme and other things that could push inflation a little bit higher, are you nervous about inflation in 2026?
Well, it's a great question. And look, they've been trying, and it's a difficult task, the last 12 or 18 months. They're toggling the two issues. They're trying to avoid the word that we haven't seen in a long time, really early in my career, stagflation. That's really what they want to avoid. So they're going to continue to try to balance it. I don't think they're going to overdo it on either side. I just think at the margin they might tolerate slightly higher inflation than they prefer. They're not going to come out and say this, I don't think. But the reality is I think that they'll tolerate slightly higher inflation than we've had. In order to deal with the employment side and the sluggish parts of the economy. The other thing, Anna, is that we have a big federal debt in the U.S., and it just continues to move forward, 5-6% of GDP. When Scott Bessent, when the administration came in, Scott Bessent, the Treasury Secretary, said they were focused on 3%, 3% real growth, 3% inflation, and 3% budget deficit.
Yeah.
We're not going to hit the 3% budget deficit. One way to deal with that is to have higher overall growth, inflation plus real growth. And if we're in the 6 to 7% range, that helps with the debt situation. And if rates are a little bit lower, that helps with the cost of the debt. So we think that's all going to be factored into the mix, and it'll cause the Fed to be slightly more focused on the employment side.
Yes, and we can wonder whether we might get those rate cuts, but if the world is worried still about inflation, we'll see what that does to the cost of borrowing in the United States. AI is clearly a big area of investment for many corporates, hyperscalers in particular in the United States, Greg. How much positivity does the AI story deliver for the US next year, do you think? Because on the one hand, many Western economies are facing demographic challenges. I was talking about this in the earlier part of the programme. On the other hand, AI can deliver on productivity and help us solve those challenges. Are you an optimist? Do you look at that as a positive story?
Yes, I am optimistic on this. And I've seen in my career now, a number of breakthrough technologies. I think AI will be the most transformational of anything that we've seen to date. I think that every single company in the United States and probably around the world, but I'm more familiar with the U.S., is focused, public and private, on how to incorporate AI into their businesses to make them more efficient, to accelerate growth, to expand margins. So, and AI is immediate, Anna, in the sense that it's here.
Yes.
The tools are already available. They get better every week and month. So I am optimistic that AI is going to have a significant impact on the American and ultimately the global economy.
And a few sectors will be spared, perhaps, including the management of people's money, the management of wealthy people's money, perhaps. I wonder what impact you think AI is going to have on your sector.
And actually, before I go there, I think no sector is spared. I think that every business will be reshaped by AI. In our business, the bulk of the work with clients, which is done by our, we call them elite private advisors, that will continue, the client interface. But the work of the team will be made more efficient by AI. So as an example, we may have a team of private advisors working with 20 families that have $50 million each. They might be able to have 40 families with $50 million each, in a couple of years as we integrate the tools into their business model and what they do every day. And that's the type of impact that I think AI could conceivably have across many industries, which is why there is the promise of greater productivity and greater economic growth as a result of AI.
So you don't think necessarily it leads to reduced face time for individual clients with their money managers? It's more that those money managers can have more relationships?
Well, definitely in our model. Our model is a high touch. We're focused only on high net worth and ultra high net worth families. And our services are intended to be comprehensive. We help them with investments, but we do generational work with them. We are focused on after-tax returns, financial education, philanthropic advisory, all of it. That requires a direct face-to-face interface between our private advisors and the families we advise.
There's a lot of focus on private markets as well, Greg. Are you in the camp that says, oh, look out for cockroaches, there's got to be some more bad apples out there? Or are you in the camp that says, actually, the leverage part of this is really quite small and it's just a big asset class, it helps to spread the risk, and you're positive?
First, let's scale it and size it. Private markets were mostly private equity and a little infrastructure 25 years ago, and was about $1 trillion market. It's over $15 trillion today, on its way to $20 trillion. It's a significant part of the investment portfolio for all, or should be, high net worth and ultra high net worth families. So it's not, a small little thing on the side. It's central to investing today. So, for us, it's an important part of our clients' investment diversification. Our clients, because they're high net worth and ultra high net worth, they can handle the illiquidity that comes with private investments. So we think it's here to stay across a wide range of asset classes.
Yeah, maybe they have that long-term mindset. Greg, thank you very much for joining us. Very good to speak to you. Greg Fleming, President and Chief Executive of Rockefeller Capital Management. Let's pivot back to the UK economy briefly, because just around 8 minutes ago, we got an interesting headline that I thought was worth mentioning around the UK construction sector, just because of its weakness. Any number that's a PMI number that starts with a 3 certainly raises an eyebrow. So UK November construction PMI falling to 39.4. The forecast was 44.6. Now, of course, we've seen a lot of questions being asked about whether the UK economy was stalling slightly ahead of the budget. The budget came at the end of November. We will see whether December delivers something more positive, or whether we are still in that sort of stall speed around UK construction. Let's pivot to technology news flow now. Morgan Stanley, one of the key players in financing the artificial intelligence race, is considering offloading some of its data center exposure via a so-called transfer risk, SRT, a significant risk transfer. Bloomberg tech anchor Tom McKenzie is with us and has been looking at the details of this. Lots of talk about AI this morning then, Tom. So what do we know about the Morgan Stanley story, about the way that they're trying to offload some of their exposure to these data centers?
Yeah, so the SRT, or the significant risk transfer product or mechanism that they use, is part of their hedging of this risk around some of the lending that they've made, pretty significant lending around the AI data center and infrastructure build. And so they have, according to our reporting, been shopping these to investors. We don't know if an investor's taken this on board, but it would be part of a Morgan Stanley strategy to de-risk some of this lending and potentially open their balance sheet for more lending into the future. We don't know if that's what they plan, but they have been, to your point, Morgan Stanley, absolutely central to getting the financing to the build-out around AI infrastructure. I can just think of one example recently in October, where they led the funding and lending about $27 billion worth of debt, $2.5 billion worth of equity for a Meta data center, a special purpose vehicle. And Morgan Stanley were a significant player in getting the liquidity and funding for that. So that's just one example. The Morgan Stanley team themselves, into the future, their estimates are that the spending by the cloud providers or hyperscalers on data centers will top potentially $3 trillion through 2028. $3 trillion, half of which they say will have to be funded by debt.
Yeah, so we'll see what they plan to do with that space on their balance sheet then. Let me ask you about some other news flow within the AI space. I mean, Microsoft have been, they were hit yesterday early in the trading session by talking other media that perhaps the sales pitch to companies to get them to spend more on AI was not going so well. They pushed back, though, against that narrative. What do we know?
They did, and they pushed back pretty strongly. To your point, so the information came out with a story that said that Microsoft were lowering their expectations around how much they were getting their enterprise customers to buy into their platform that gives them access to a whole range of different AI models and products that allows these companies to build solutions in their own enterprises. And the information saying that that was after quotas for salespeople within the Microsoft team had been lowered after they missed some targets back in June. To your point, Microsoft put out a press release and a statement pushing back very strongly on this. They said that the story by the information inaccurately combines the concepts of growth and sales, and importantly, aggregate sales quotas for AI products have not been lowered. That was the statement from Microsoft on the back of that. The shares then did recover somewhat. They did end up a little lower, but not as much as the initial drop. Jefferies analysts, interestingly, did their own channel checks and spoke with management and Microsoft in reaction to this. And they say that their channel checks show that there is still robust adoption of Copilot AI assistance, which is a key product for Microsoft getting into the enterprise space with agentic AI.
OK, so we'll absorb any take we can get on how quickly businesses or otherwise are adopting these AI technologies. Tom, thank you very much. Tom McKenzie, then, tech anchor, Bloomberg tech anchor here in London with the latest on those tech themes. Back to geopolitics, and the US envoy Steve Witkoff is due to meet with the Ukrainians in Miami today. That is according to a US official. The talks follow his meeting with Vladimir Putin, but President Trump acknowledged he doesn't know what the outcome will be after successive rounds of talks over a deal to end the fighting in Ukraine.
President Putin had a very good meeting yesterday with Jared Kushner and with Steve Witkoff. What comes out of that meeting, I can't tell you, because it does take two to tango. You know, Ukraine, I think we have something pretty well worked out with them.
Let's bring in Bloomberg's chief Europe correspondent, Oliver Crook, who's been certainly following this story very intensely over the last few days with all the meetings, NATO and otherwise, that we've seen taking place. Ollie, good morning. So what comes next here, then? We've seen meeting after meeting after meeting. What now?
I think that really the big change here is the cadence at which this sort of peace proposal is actually going to get through and the expectations on negotiations. You heard it there from President Trump saying, you know, he's basically unclear on what the next steps are. He says the talks were reasonably good. Usually he's drenching these sort of comments in superlatives. That is not what we're hearing from the President of the United States. So I think at this stage, you have basically three options. Today, you have the discussions with the Ukrainians in Miami with the U.S. delegation. The two sort of first options hinge on who President Trump sees as the obstacle to peace. Is it Vladimir Putin? Is it Zelensky? As we know from that horrible meeting that began back in February between Zelensky and Trump, Zelensky has done everything in his power to basically say, yes, we're on board with whatever initiative you have. We are not the obstacles to peace. Trump goes, back and forth on these two things. The third option is, of course, that he could just then tap out of these negotiations. We saw that happen where the United States basically withdraws from these, saying that this is a little bit too complicated for now. The issue for the Ukrainians right now is that these peace negotiations potentially are putting the brakes on some European allies. The Italians, for example, saying they're not going to contribute to some of the weapons programs to Ukraine because they want to see how this sort of plays out with the peace negotiations. So again, that could be a sort of a meaningful pain point for the Ukrainians.
And meanwhile, the Ukraine topic finds its way onto the agenda at many geopolitical encounters. France and China, we've seen Macron meeting Xi, and clearly Ukraine was part of the conversation there. But perhaps there is a hope that India will say something to Russia when it comes to that meeting between President Putin and Modi. But we know that Putin is in India, and the two nations have just signed a deal around submarines. Yeah. What else is being talked about?
Yeah, so what's interesting there is it's a $2 billion deal where the Indians would basically lease nuclear-powered submarines from the Russians. They'd lease them for about 10 years. This is theoretically not for combat operations, but for training exercises. But I think what it highlights very significantly is this sort of state of strategic autonomy that the Indians are taking in terms of the geopolitical order. The Trump administration obviously has put those tariffs on the Indians to get them to stop buying Russian crude oil. That has obviously not worked so far, those 50% tariffs. But I think the other thing it highlights for Vladimir Putin is to sort of demonstrate to the world stage, A, that he's not a pariah and that he's going to these nations, he's having these meetings with these leaders, but also he's not too stressed out about the Ukraine war situation. If this was a leader who thought he was going to get this peace deal over the line over the next few days, he probably wouldn't be leaving Moscow, but he's really trying to demonstrate that this is sort of a footnote for him, that everything is in hand over in Russia.
Yeah, we will see whether we get a deal or not on Ukraine. Thank you very much, Ollie, for bringing us the latest. Bloomberg Chief Europe Correspondent Oliver Crook. Coming up up on the programme, I'll be joined by the Goldman Sachs Vice Chairman, Robert Kaplan. We'll get his outlook on the US economy next. This is Bloomberg. Welcome back. This is The Pulse at 9:47 here in London. Let's turn once again to the US economy. US companies shared payrolls in November by the most since early 2023, adding to concerns about a more pronounced weakening in the US labour market. I'm very pleased to say joining us now is Robert Kaplan, Vice Chairman at Goldman Sachs, previously, of course, served as the President of the Federal Reserve Bank of Dallas. Robert, very nice to have you with us. Thank you so much for coming in. So let's talk about the here and now in the US economy and what you see weakening in the labour market. Is it right that the Fed should focus on the weakness in the labour market right now?
There's no question that labour market is weaker and very sluggish. There's three reasons why. One, tariffs, at least in the short run, are slowing growth in the United States, and they're affecting small business disproportionately. And you saw in this recent job weakness, a lot of the weakness was in small business. That makes sense. Second, there's been constraints on labor force growth, which reduces supply, but also there's a multiplier effect when jobs go unfilled. It creates other jobs that would have been created. You know, there's another half a job that would be created for every job goes unfilled. And then the shutdown has been a headwind for growth. So it's not surprising you're seeing some weakness. The trick for the Fed is as you head into 26, we've got a few tailwinds that may come to the fore. Tax incentives, tax on tips, tax on overtime, accelerated depreciation, regulatory relief getting further along, and then still the AI data center power boom, I think, is underway. So that's why they're balancing what's the here and now versus the headwinds likely in 26.
And of course, there's a lot of focus on who's going to lead the Fed and who is going to be leading those conversations about the balance between inflation risks and joblessness risks in the United States. What's your thinking on the extent to which the market is concerned about the person themselves? I mean, this is, in the end, setting policy as a group activity, but the chair clearly has a big voice at the table. What should we know about the way these decisions are made and how much it matters who leads?
So the Fed is focused on full employment and meeting a 2% inflation target. And the reason they're sticking with the 2% inflation target is there's still 85 million workers in the United States that make 50 or 55 grand a year who are struggling to make ends meet. So affordability is a big issue in the U.S. I think any of the candidates mentioned have the intellectual capability and leadership capability to balance those issues. I think whoever's in the job, and I won't go through individual names, they will need to show that while they may be from the administration or other sources, they're going to be intellectually willing to balance those issues and have that debate without regard to political pressure or political considerations. And that's, I think, what the market wants to see.
Yes. I mean, how nervous are you about political pressure to get rates lower in the United States? Is this something that should preoccupy market participants?
Well, it is natural for administrations to want lower rates. Lower rates mean higher real GDP growth, higher nominal growth. But that's why the Fed is a little bit, has to be independent and when necessary push against that. So I think any of the candidates have the capability of doing it. And my advice to any candidate would be, if you're in the job, you want to reiterate that you're going to respect and try to preserve the independence of the Fed, at least on setting the Fed funds rate.
If the White House, if the Fed wants lower interest rates in the States, and if that's what they deliver, if the market then worries about inflation, does that mean that the lower rates the Fed sets don't necessarily get passed on to the real economy? So could lower rates actually be self-defeating?
So the Fed only controls the front end of the curve. And so what you've seen, the Fed has cut 150 basis points since September of 24. The 10-year has hardly budged. Okay, it's down just a touch. And so the curve has gotten steeper. So, yeah, the market sets rates along the curve, and the further out the curve, the more they're market determined. And so the Fed's got to be aware that, has to have credibility for its actions.
And are you concerned about overheating at all in the U.S. economy around the AI theme? Is that, you talked about how that there are going to be some tailwinds around fiscal stimulus in the States, tax cuts, also the AI build-out.
There is going to be a firming, we believe, at Goldman Sachs. We believe that in 26, GDP growth is likely to firm. I think there's clearly enormous infrastructure spending for AI, data centers, power. We're in the early stages of AI adoption. I think there's a lot of worry, gee, is the AI infrastructure build overdone? I don't think it's overdone yet. We'll get to the point where we will think it's overdone, but we're in the early stage of downstream adoption. And so I think we see firming growth. I don't see an overheating. But when you have firming growth, you got to be worried inflation is running 2 3/4, 3%.
Yes.
And so the Fed just got to be very mindful of that.
And at the coalface of the sort of news flow around corporate adoption of AI, we get drip-fed little nuggets of information about these businesses adopting quickly. Here, there's some pushback. What's your big picture expectation about how quickly this can change the productivity narrative for the U.S. economy?
When we're sitting here talking 5 years from now, I would guess that you're going to see productivity growth in the United States and globally. But let's take the United States as that could be a 0.5 percentage point, we believe, higher. Corporate margins could be better. That's on the one hand. On the other hand, businesses are more likely to get disrupted. They've got to spend on AI. In the short run, that may come out of margin. Over the long run, I think businesses who do it well are going to be more productive. So I think we're going to see the benefits. The surprise is going to be which use cases work and which use cases we thought would work but don't, and how does it affect industry and how does it affect labor?
Yes.
And so we're early in that workers are going to get disrupted out of functions, out of companies. They're going to have to move to other functions and companies. This is where early childhood literacy, secondary education, skills training, and adaptability of the labor force is going to get more important, and successful countries will invest in that. So labour markets will need to adapt, and policy. What should policymakers, I suppose, keep in mind when it comes to labour markets and how quickly we might see the effects of AI on redundancies? I think the thing about AI, unlike other technological and other structural change, is how fast it's going to happen. So policies need to be, makers need to be aware. You're going to have mismatches. You're going to have lots of people looking for jobs. You know, computer programmers who used to have plentiful jobs now will need to find other types of work, but there's lots of open jobs also. Window installers, automotive technicians, electricians, and we've got mismatches. I would guess in the next 2 or 3 years, you'll see that continue. Those will get solved with the passage of time. But I think we're going to have to help people make the adjustment. So there's cyclical issues where lack of demand creates labor slowing, and then these structural mismatches. I think we're going to see more structural mismatches, maybe even if cyclically we're firming. And on that structural story, is it your sense then that the negatives kick in more quickly than the positives? So the job cuts come and then the productivity gains come later? I think human beings sometimes takes them a while to change their aspirations, change their job goals. And I think this is where we have to do a better job educating workers, helping them adjust, making that transition. But AI is happening so fast that the workforce may lag adopting. And also worker mobility, geographic mobility is probably historically low right now. You know, the house, its situation, you have already own your home, fixed rate mortgage. We're going to have to help people adjust. OK, Robert, thank you very much. Thanks for joining us. Rob Kaplan, Vice Chairman of Goldman Sachs and previously, of course, of the Dallas Fed. Our thanks to Rob for joining us. Really great to get his perspective on the AI up and downsides for the US economy and the Fed conversation, of course. Up next, a Bloomberg brief. They'll be running you through the run-up to the market open over in the United States. Here in Europe, we have European stocks going higher. Stock 600 up by 0.3% right now. German stocks outperforming just a little bit this morning. This is Bloomberg.